It's the early 1700s in Britain, a time when the air buzzes with tales of wealth from distant lands, gold, silver, and treasures from the Americas. Ordinary people, from cobblers to aristocrats, are gripped by a feverish dream of riches. They're investing everything they have into a single company, promising to make them wealthy beyond imagination. This isn't a fairy tale. It's the South Sea Bubble, one of history's wildest financial roller coasters. In this video, we're taking a deep dive into the South Sea Company's rise and fall. How did a modest trading outfit spark a national frenzy? What drove its stock from modest beginnings to astronomical heights only to crash and burn? And what can this 300-year-old story teach us about today's markets? We'll cover the economic backdrop, the company's audacious debt scheme, the manic stock surge, the devastating collapse, and the lessons that still echo in our modern world. Whether you're here for history, finance, or just a gripping tale, stick around. This one's got it all. Let's rewind to 1711. Britain is staggering out of the War of the Spanish Succession, a grueling conflict with France, and Spain that's left the nation victorious but broke. The government's debt has ballooned to £10 million, an eye-watering amount equivalent to billions today. Interest payments are crushing the treasury, and the economy is teetering. People are restless, merchants are struggling, and the government needs a lifeline. Enter the South Sea Company, founded that year by a mix of savvy merchants and cunning politicians, led by Robert Harley, the Earl of Oxford. On paper, its mission was simple: trade with the Spanish colonies in South America, a region dubbed the South Seas, brimming with potential. Think gold mines, silver fleets, and exotic goods, riches that could rival the Spanish Empire's haul. But there's a hitch. Britain and Spain are still at odds, and even after the 1713 Treaty of Utrecht ends the war, Spain grants Britain only a tiny sliver of trade access, one ship per year, heavily taxed and restricted. Hardly the makings of a trade empire. So why did anyone believe in this company? Because its real genius wasn't trade, it was financial wizardry. The founders, particularly the ambitious John Blunt, saw a chance to turn Britain's debt crisis into profit. They pitched the South Sea Company as a dual-purpose venture, a trading outfit with a speculative allure and a financial machine to rescue the government. It was a gamble dressed up as a sure thing, and soon it would captivate the nation. Fast forward to 1719, and the South Sea Company unveils its masterstroke, a plan to take over Britain's national debt. Here's how it worked, step by step. The government owed millions to bondholders, people who'd lent money in exchange for bonds paying steady interest, say 5% a year. The South Sea Company proposed a swap. Bondholders could trade those bonds for shares in the company. The company would then assume the debt, and the government would pay the company a lower interest rate, maybe 4% on that debt. The company would pocket the difference, and shareholders would supposedly rake in profits from South Sea trade. Sounds clever, right? Imagine you're a bondholder with £100 in government bonds earning £5 yearly. You trade them for South Sea shares, betting the stock will rise and you'll make more than that £5. Meanwhile, the government saves money on interest, and the company gets a steady income stream. Win-win-win, except it wasn't. The catch? The company's trade was a fantasy. That one-ship-a-year deal with Spain was a trickle, not a torrent. In its first decade, the South Sea Company barely turned a profit from trade. Some years it lost money. The debt scheme's success hinged on convincing people the stock was valuable, not on actual business results. To pull this off, the directors spun tales of boundless wealth from South America, painting vivid pictures of treasure-laden ships. They even offered loans to buy shares, fueling the hype. It was a house of cards built on hope and exaggeration, and it was about to soar. In January 1720, South Sea stock traded at £128 per share, a respectable price for a fledgling company. But then the debt scheme kicked into gear, and the directors turned up the volume on their promises. By spring, shares were at £300, but by June, they soared to £10.50, a mind-blowing 700% jump in just 6 months. What caused this wild ride? Greed, optimism, and a dash of desperation. Investors saw early buyers cashing out with huge gains and wanted in. Stories spread of servants becoming millionaires overnight, of lords doubling their fortunes. Take the South Sea cobbler, a shoemaker who sank his savings into shares and briefly lived like a king. Or the clergyman who pawned his church's silver to invest, preaching prosperity to his flock. Even Sir Isaac Newton, the genius behind gravity, jumped in, made a profit, then bought back in at the peak, only to lose 20,000 pounds, lamenting, "I can calculate the motion of heavenly bodies, but not the madness of people." London's Exchange Alley became a circus. Crowds swarmed the cramped streets, trading shares in coffee houses and taverns. The frenzy birthed bubble companies, fly-by-night ventures peddling absurd ideas. One promised to extract gold from seawater, another pitched a perpetual motion wheel. A famous scam advertised, a company for carrying on an undertaking of great advantage, but nobody to know what it is. People threw money at anything with a prospectus. The South Sea directors fanned the flames, issuing new shares and lending money to buyers, inflating the bubble further. Society was hooked. Wealth seemed just a share away. But beneath the euphoria, the company's foundation was crumbling. By summer 1720, cracks appeared. The South Sea Company's trade profits were laughable. Some years, its ships returned empty. Investors started asking hard questions. Where's the money coming from? At the same time, rival bubble companies were draining cash from the market. Alarmed, South Sea directors pushed the Bubble Act through Parliament in June, requiring all joint stock companies to have a royal charter. They hoped to crush competitors, but it backfired. People began doubting all stocks, including South Sea.
Do you like to dig deeper? Political economy is full of powerful ideas. You're right in the thick of it. Insightful, thought-provoking, expanding every step of the way. From Adam Smith and the rise of capitalism to Marx's bold critique, mercantilism, Keynesian economics, neoliberalism, and more. Or we explore it all, clearly and from every angle. Keep the momentum going. Check the links, dive deeper, and subscribe for more.
In July, the stock wobbled. By September, it crashed to 150 pounds. Panic set in. Investors who'd borrowed to buy shares faced ruin. The South Sea cobbler lost everything. The clergyman faced disgrace. Families sold homes to cover debts. Some took their lives. The crash triggered a recession. Banks folded, trade stalled, and unemployment spiked. Parliament launched a furious investigation. It uncovered rot. Directors had bribed MPs, lords, and even royal aides to prop up the scheme. John Blunt's fortune was seized. He and others faced jail. The Prince of Wales, a heavy investor, lost a bundle, staining the monarchy's image. Satirists like Jonathan Swift mocked the fiasco, cementing bubble as a byword for folly. The economic scars lingered. Trust in stocks evaporated, slowing Britain's financial growth for decades. Yet the South Sea Company limped on, managing debt until the 1850s, a ghost of its former hype. The South Sea bubble wasn't a one-off. Look at tulip mania in 1630s Holland, where tulip bulbs sold for more than houses, only to crash. Or France's Mississippi bubble, collapsing alongside South Sea in 1720. Fast forward to the dot-com bubble of 1999. Tech stocks soared on promises, then tanked. The 2008 housing bubble followed the same script: hype, overvaluation, collapse. Today, we're not immune. Meme stocks like GameStop in 2021 saw retail investors on Reddit push prices to absurd heights, echoes of Exchange Alley AS chaos. Cryptocurrencies like Bitcoin swing wildly, driven by hype over substance. The tools have changed, social media, trading apps, but the psychology hasn't. What's the takeaway? First, beware the hype train. When everyone's buying and prices defy logic, it's a red flag. Second, know what you're investing in. South Sea investors ignored the company's weak trade. Modern ones might overlook a crypto's fundamentals. Third, governments matter. Regulation can steady markets or spark panic, as the Bubble Act did. Economist John Kenneth Galbraith nailed it. Financial genius is a short memory in a rising market. Bubbles thrive on amnesia. And as Newton showed, even the smartest can fall prey to the madness of people. It's human nature. Greed blinds us, fear sobers us up. The South Sea bubble is a wild tale of ambition, delusion, and reckoning. It's a mirror for today's markets, where new bubbles brew in plain sight. So next time you hear a can't-miss investment, pause. Ask, is this real or just another South Sea mirage? Thanks for watching. If this dive into history's craziest bubble hooked you, hit that like button, subscribe, and ring the bell. Drop a comment. What's the wildest financial story you've seen? See you in the next one.